Thank you for that introduction. I normally come on stage to throbbing dance music and a smoke machine, given regulation is my focus. I'm just going to put that up there for a second. Quick show of hands for anyone in the crowd who knows what this means. I didn't either a couple days ago. My daughter told me that if I use a Latin phrase, people will think I'm smarter. You can tell me afterwards if you think that worked. So what it means is forewarned is forearmed. And what I'm going to try to do in a humble way is tell you a little bit about the future of regulation for the wealth management industry, and talk also a little bit about our analysis into how the fiduciary duty rule may impact the industry in the long run. But first, a little bit about my firm, Capstone. We are a policy analysis and regulatory due diligence firm, and what that means in plain language is that we focus on ideas, investment ideas, developing investment ideas for corporations, investment firms like private equity, hedge funds, institutional asset managers, and we do it in a particular way. We do it through deep dive analysis of public policy, both on a federal and state level. We also have an office in London, so we focus on policy in the EU as well. The firm as a whole focuses on a lot of different areas in regulation, but financial services is a critical part of what we do. It's the biggest part of what we do. And the fiduciary duty rule has been a huge focus for our firm over the past several years. Just a little bit of background of our work on the fiduciary duty rule. We started working on the rule back in 2010 when it was originally proposed. Our analysts have read thousands of comment letters. We have done hundreds of interviews with policymakers, both at the Department of Labor, at the SEC, as well as industry leaders, academics, consumer advocates. We have spent an inordinate amount of time. And I wanted to talk a little bit about the history of the rule, because I think it's important to understand the context of where it came from and how the two sides, the two parties really look at it, just briefly. As you know, it was proposed in 2010. It was withdrawn in the face of pretty stiff industry opposition. And then it was reproposed in 2015 and finalized in April of this year. One of the most, I think, compelling quotes that we got from an interview was with a senior person in the administration, a senior person at the White House, who told us that they believed that the fiduciary duty rule was the single most important thing that the administration could do for the middle class. That gives you some insight into how the policymakers, at least in this administration, really view the rule. Suffice it to say that the other side of the aisle, the Republican caucus in the Senate and the House, are very much against the rule and have tried in several different ways to stop its progress. I also wanted to talk a little bit about, since I think there's an election coming up, I wanted to talk a little bit about attitudes towards the rule in the next administration. Our interviews with Clinton policy folks in her campaign would indicate that she's likely to follow the same path that the Obama administration has followed. The interviews that we've done with folks in the Trump campaign, which are fundamentally more difficult to do for us, show quite the opposite. We think that one of his key economic advisors is extremely focused on derailing the rule, and that could happen in a couple of different ways. To negate an existing federal rule, President Trump would have to completely run a brand new federal rulemaking process. Or if President Trump also has a Republican Senate, it's possible that a law could be passed that he would then sign that would negate the impact of the rule. That is not our base case for a variety of reasons, but it is possible. This is just a handful of quotes, again, sort of illustrating some of the different views of key policymakers for and against the rule. And now I want to focus a little bit on the less obvious parts of the rule. I think I've assumed that most of you have a pretty good working knowledge of what the rule does in fact. But there are a handful of things that, as we analyze it and our team of analysts work on it and try to predict what the outcomes could be, there are a few key points that we keep coming back to that seem particularly thorny and difficult to deal with. The first, as you probably know, is the enforcement mechanism. There is no enforcement division at the Department of Labor. The enforcement mechanism for this rule are the trial lawyers of America. And if that scares you a little bit, it probably should. The things that we worry about when you have to make a rule where the trial lawyers are the enforcement mechanism is it's very difficult to understand where you draw the line. If you're dealing with an enforcement division at a federal agency, you can have conversations, you can talk to them, you can explore where the line should be drawn, you can get pretty detailed guidance over time. With trial lawyers, you can't. You have to make a judgment and then judge your litigation risk. And this makes, and I'm cognizant of the fact that I probably don't need to tell you, but this makes complying with the rule extraordinarily difficult. Where you draw the line, how you game out, where the trial lawyers will go first, where they see the low-hanging fruit, how they will make their arguments. That is incredibly important to complying with the rule. We have done, our analysts have done over 30 interviews with trial lawyers, trial lawyer associations, trying to get a sense of where they will go first and sort of how they see a potential lawsuit shaping up on some of these issues, and we'll get to that in a moment. The other thing about the rule is that fees and commissions need to be reasonable. That is a vague standard. I think everyone can understand that. It is, according to the rule, a market-based standard. So, and this creates some problems for a number of different products, but determining what is reasonable is really going to be a function of deciding where you are based to the rest of the market. And that, we think, could have pretty significant impacts on the sales of key products, again, which we'll get to in a moment. And then finally, and this is overlooked a little bit, there is a prudent man standard implied in the rule. And the implications of that are tricky. So one of the potential implications of that comes in the form of the debate between active versus passive mutual fund management. And we think there is some possibility that even outside of a commission structure, I guess better said, independent of how much commission you're paying, or if there's a levelized commission structure, there may be a possibility the trial lawyers could argue that advisors who choose higher cost ratio mutual funds are not acting in the best interest of their client, even if they're not influenced or incentivized by differentials in commission. So this is a pyramid, obviously. And at the top are things that we think, products, revenue streams that we think are most impacted by the rule. And at the bottom we think there's the potential for impact, but we include them because even a small potential for impact would have very significant ramifications for the average large independent broker-dealer. But I should stress that and I'll go through these one by one, that the things at the bottom, our base case is that the impact of the rule would be relatively small, but there is some risk there. So at the top, alternative products, non-traded REITs, non-traded BDCs. In the original version of the rule, the proposed rule, commissions were banned completely. In the final version of the rule, they were called out specifically and for greater scrutiny and greater record keeping. And our assumption is that across the industry, the sale of non-traded REITs, non-traded BDCs, and perhaps some other alternative products, the sales of those products will drop dramatically. The next product is variable annuities. Variable annuities were called out specifically by folks at the White House and the Secretary of Labor on a number of different occasions. Secretary Perez's favorite examples when discussing the rule of bad behavior have to do with variable annuities being missold. The impact of variable annuities, the rule impacts variable annuities in a number of different ways. The first one's fairly obvious. There has to be a levelized commission for variable annuities as an asset class, which will generally mean the commissions come down, which we think will impact the sales. Number two, there's scrutiny just when it comes to the sale of variable annuities into a tax-qualified account. And the basic reason there is fairly simple. The main feature of variable annuity is that it's a tax-deferred product, and so that raises natural questions about why you're selling it into a tax-deferred account. So we think that the commissions will come down. They certainly have to be levelized. There'll be greater scrutiny over the decision to put a variable annuity into an IRA. And then on top of that, one of the lesser understood parts of the rule is that if you're going to pay a higher commission for the sale of a variable annuity than a mutual fund, that's not a market-based standard. You have to defend that higher commission paid for a variable annuity on the basis of what's called neutral factors, which means that you have to basically make an argument that an advisor is getting that higher commission because they're doing more work, either research or spending more time with the client. And we think that is not necessarily an easy process. Guidance came out a couple of weeks ago, long awaited, from the Department of Labor, that actually spelled out more about that neutral factor process. And one of the things it said was that advisors actually have to write down and keep track of those neutral factors. They have to prove that they spent more time doing research. They have to prove that they spent more time walking the client through the product, which is not what I think the industry broadly expected. So again, we think that that could impact the sale of variable annuities pretty significantly. The next big one is mutual funds. Also, this is one asset class, and it will have to have a levelized commission. For a variety of legal reasons, creating a levelized commission structure for mutual funds is extraordinarily difficult. We think the rule will generally have the impact of lowering loads across the industry. Also, and I mentioned this earlier, the prudent man standard may mean that higher priced, high cost ratio mutual funds, actively managed mutual funds as opposed to passive, will receive a great deal of scrutiny. And when we've interviewed trial lawyers and trial lawyer associations on this particular issue, they get very animated. And we get the sense that although variable annuities and alternative products seem more straightforward, an argument for them to make, they're really pretty focused on mutual funds. And I think part of it is, as one trial lawyer explained to me, they can imagine being in front of a jury and thundering away, describing reams of academic data which show that actively managed mutual funds are worse than passively managed mutual funds, and then pointing to the commission, the very large difference in commission, as the reason why the advisor decided to put the client into the mutual fund. And they think that's a case that might be easy to win. Revenue sharing, cash sweep, and wrap fees. Again, I want to stress that we don't think that the rule impacts these directly, or if they do, there are ways to mitigate it. And so our base case isn't that these are areas that are heavily impacted by the rule, but there's a risk. And so because they are three areas that are very, very important to the average broker-dealer model, I bring them up and I'll go through them pretty quickly. Revenue sharing, the rule, a strict reading of the rule suggests that it is allowed, but there are some caveats. If revenue sharing severely restricts the choices that an advisor has and thereby an investor has about what products they can buy, then that could create a pretty big problem. It is also important that revenue sharing doesn't filter down to the advisor, that it has no way to impact or incentivize their decision. Having policies and procedures that make sure that happens is incredibly important. Cash sweep, which is often a very important part of the profitability of the average broker-dealer model, could also be impacted by the fiduciary duty rule. If what to do with your cash, it comes in the form of a recommendation, it's covered under the best interest contract, and you have to act in the best interest of your client. So if you are putting your client into a lower yielding product, perhaps without FDIC insurance, but one that pays your platform more, that could clearly be a problem. It should be added that most of the broker-dealers that we've analyzed are actually doing the opposite. They're putting their clients into higher yielding products that have FDIC guarantees, and so generally speaking, we don't think that's a problem. Wrap fees, they're obviously already subject to, fee-based accounts are already subject to a fiduciary standard, but how is it impacted by the rule? We believe that one of the impacts of the rule is naturally there will be a shift from, there will be a tendency to shift accounts from a commission-based world to a fee-based world in a hurry. And in that process of trying to shift clients and advisors into a fee-based world in a hurry, there is the possibility that you will see a lot of discounting. So if a client is reluctant to do this, I think what one broker-dealer has suggested is that they will promise the client that they will pay no more in a wrap fee than they did last year in commission. But the downside of that is that can tend to have a deflationary influence on fees. And so so there is an impact. What is the impact on the industry in the long run? This is good news and bad news. It's not all bad news. We think there'll be consolidation. We think it's pretty clear that smaller broker-dealers will have difficulty dealing with the compliance spend, the litigation risk, dealing with the policies and procedures in the long run of this shift, and that over the next 18 months, there'll be a large number of broker-dealers that'll be for sale at historically low valuations. So for large platforms, this is an opportunity to get size and scale that may be once in a generation. The second, in which we just discussed, a shift from commission to fee-based, is fairly obvious. It is easier to comply with the rule, or you can avoid the rule altogether if you make this shift. And those advisors and customers who may have been reluctant to do it in the past may accept the fact that the rule is just shifting everybody in that direction and may be easier. As we analyze independent broker-dealers through public disclosures, it's pretty clear that the average commission, let's call it about 70 basis points, the average commission scrape, is lower than the average fee, which is 110 basis points. And so it should, in theory, be accretive. There's a possibility that making that shift may mean you lose some revenue sharing or shelf space fees, but by and large, we think this is a positive thing for the industry. And I'll come back to this at the end, but there's also a need to train your commission-based brokers to be advisors, to be planners. Looking to the future, you can't ignore the fact that the SEC is clearly working on a rule. We know that they're doing that. The SEC is notoriously slow. They are also much closer to the industry. We know from leaked emails that they didn't love what the Department of Labor did, but they are clearly working on a rule. We think Capstone believes that the rule will not be significantly weaker. It's not likely to be worse, but it won't be significantly better, and we think that's largely because of politics, that it would be extraordinarily difficult for the SEC to make it, to distance themselves dramatically from what the Department of Labor did in terms of investor protection. The enforcement issue, unlike the Department of Labor, which we discussed was the Trial Lawyers of America, the SEC does have an enforcement division. And so the added awkwardness of an SEC rule is that you will not only have to worry about litigation, you will actually also have to worry about a group of fairly aggressive enforcement folks. And so one second on the difference between the SEC policy and regulation folks and the enforcement division at the SEC, they're worlds apart. So broadly speaking, the SEC regulation and policy staff are very close to the industry. They would tend to listen to the industry a great deal before coming up with policies, and they tend to be pretty reasonable. Enforcement folks are not that reasonable. They are notoriously aggressive. Everyone in the industry is extremely afraid of them, and the specter of dealing with them in the context of a fiduciary duty rule is a daunting one. I would also add there is another element that I think is really important when you're looking to the future, and that's the concept of reverse churn. So out of nowhere, in 2014, the SEC put as an enforcement priority the concept of reverse churn. And our conversations with different policymakers at the SEC indicated that that's no accident, that they meant for that enforcement priority to come in as the Department of Labor was producing a proposed rule. Reverse churn, for those of you who don't know, is the concept of migrating somebody from a commission-based account to a fee-based account and then not doing anything for them, just leaving them be. It's also particularly sensitive if you generate a lot of commissions with the account during a short period of time and then make that migration. So in this world where the Department of Labor's fiduciary duty rule is going to tend to see a huge migration from commission-based to fee-based, the enforcement division of the SEC is saying loud and clear, we're going to be watching. We're going to be making sure that as you're migrating all of these people into a new form of a relationship, that you're doing things for that fee that you're getting every month, every quarter. So I think from our point of view, as we analyze the industry, I think one of the biggest messages is to to build for the long term, to look beyond kind of what the rule requires today, to think about what the SEC rule may say, to think about how the industry is going to change and how your sales strategies or your systems can deal with that, not just over a 1 or 2 year period, but over a 5 or 10 year period. That's my presentation. I'm happy to take questions if there are any. There's one coming.
So, how will the trial lawyers determine what is a reasonable fee? How will that process play out over the next year, year and a half in your mind?
It's a great question. I think one of the most interesting potential answers to that question is we don't know, and that uncertainty creates a huge difficulty. But at the end of the day, it's a market standard. So if you believe you're in line, if you can prove that you're in line with the rest of the market, you have a certain amount of defense just there. But there is another element to the reasonableness, which is you have to prove that commission, that added incentive is driving some sort of outcome for the client. Whether it's if you get a higher commission for selling actively managed mutual funds, there has to be some demonstration that you've done research, that you've produced something for the client at the beginning that they wouldn't ordinarily get.
Yeah, just a question about do you think that this is the end of active management?
It's a really good question, and I think that in fact we spend more time trying to answer that question than on almost any other. Certainly, the issue of charging the same commission in an asset class is a difficult one. So if you think of passively managed mutual funds and actively managed mutual funds, paying the same level of commission between those two products is tricky. One is extremely low normally, commission paying, and the other is extremely high. So where you come out on that is a difficult one. One answer is don't offer passively managed mutual funds. But what we have seen in our research in the 401k industry, which isn't a perfect analog, but it's pretty close, that there have been a number of high-profile legal settlements from sponsors who failed to offer low-priced options, passively managed mutual funds or ETFs, and the number of those settlements is accelerating, and the awards are getting higher and higher. So we think that that the rule is very bad for actively managed mutual funds. Whether it's the end is debatable, but we think probably one of the most underappreciated impacts of the rule is that this is very, very bad for actively managed mutual funds. Great, thank you.